Welcome to Independent Living Bullion's weekly market wrap podcast, helping precious metals investors during these treacherous times. And now, here's this week's market wrap with commentary and analysis from the fastest growing precious metals dealer in America, Independent Living Bullion.
And I'm happy to welcome back our friend David Morgan of the Morgan Report and silver-investor.com. David, thanks for joining us again, and Merry Christmas to you.
Well, Merry Christmas, and thank you for having me.
Well, to start out here, I have to ask you about the big news of the week, of course, that being the Fed announcement. They claim they will begin a 12% tapering of the latest round of QE starting in January, and it sounds like they felt they had no choice but to do some token amount or see their credibility totally collapse. So what did you make of all that, and what do you expect moving forward with Fed policy, especially with Janet Yellen taking over as Fed chair here pretty soon? Comment on that first and foremost, and then also the impact it will likely have on inflation and on precious metals prices.
First of all, I wasn't shocked. I thought that they were going to taper, and token amount, I think, is the correct wording. Basically, the $10 billion that they are going to taper by is a bit of a misnomer. I'm going to be going through this in very good depth in the Morgan Report for the January issue. But they get maturing securities, and they roll those over and apply that to their bond purchases. So the actual purchases are really well above the $85 billion mark that's out there for public consumption. So it is a gesture. I said on a previous interview that I thought it would be done. Again, I didn't think it would be done at this exact time. And done with an effort to determine, one, some credibility, so that some of the suckers that are holding the U.S. bonds are likely to maybe continue to hold them or buy more. Secondly, I thought it would be to determine what the market reaction would be without intervention. So they're going to take a good hard look at the stock market, the bond market, and the gold market, those three primarily, to see what the reactions will be by this tapering. Quote-unquote tapering. So what effect will it have longer term on inflation? None, really. You continue to add money to the money supply, no matter what the rate. That's by definition from the Austrian school, that is more inflation. So the inflation continues as heavily or not. It's decreased by about 11%, but again, that's a misnomer because of the maturing securities that hopefully some people understand what I'm saying. It's not that complicated, but it'll be outlined again in the full Morgan Report in January, exactly what's truly going on. As far as Yellen, when Dr. Greenspan was the Fed chairman, I constantly referred to him as Dr. Green Expand instead of Greenspan. It was Green Expand, being a moniker for the greenback being expanded under the Greenspan regime. And then, of course, Bernanke took over from there, and known as Helicopter Ben. And during this little brief memo that I put out to the Morgan Report subscribers yesterday, I called it, it's Janet Yellen, the money supply is a swellin'. So it's the swellin' money supply Yellen. She's not going to change anything. In fact, further on into the editorial for the Morgan Report in January, I'm going to go into what her bias is and what her thinking is and what her irrational, non-Austrian views will do to the decisions made by the Federal Reserve, because as chairman she has, a great deal of influence. So none of it adds up for anything but bullishness for hard assets, commodities in particular, real things, real assets. And of course, as you know, I think and believe that the precious metals are the top tier of all that. I'm not saying that food is more important than gold. I would say that it is, but I'm saying from a financial perspective, that gold and silver are the top tier. So, Mike, I'm not surprised. I'm concerned as always. I won't be overly concerned, but I am concerned enough to state that things are not going to be getting better over the next 2 years or 3. They're going to continue to grind down, and as I said in my memo, the Fed, in my view, is starting to lose some control. And at some point, the market forces are greater than the Federal Reserve, and I know there's probably a lot of listeners that say that I'm full of it, but history bears that out. And it doesn't have to be the Americans that do it. It could be China, it could be India, it could be electronic platform that goes down. Remember the fat thumb trade and there's so many things out there. Japan, I mean, everyone's looking at the euro and the eurozone and the austerity and the riots and all that should be observed. But Japan is the second largest holder of U.S. debt after China. So with the Chinese and the Japanese both kind of at each other's throat with this island situation, who knows? I mean, that's a tactic too. If the U.S. sides with Japan, which they are, the Chinese might, dump some bonds, or if it went the other way, which it doesn't look like it would, Japan could do something. So it's very tenuous, and it's a lot more fragile than most people would believe. Unfortunately, since it's so massive and the whole system really is based on the debt markets, once the bond market goes crazy or starts to unravel, is probably a better choice of words, beware, because things could start to happen and accelerate.
Well, speaking of the Fed losing control and those market factors you talk about, many believe the equities market is pretty overheated right now and could be due for a fall. And I want your opinion on what might happen to the metals if we did get a major stock market correction. Will we see a big downdraft in the metals like we did in 2008, meaning they get taken down with the stock markets, the stocks themselves, or will the PMs actually assume some sort of safe haven asset status in that scenario?
Well, I think this time what you'll see is some kind of sell-off in the metals, very, very temporarily. They're pretty much washed out, and I think they found their bottom, although a massive stock market unwinding could certainly send gold and silver down. I don't think it'd send the mining equities down at all. I mean, it might send them down just ever so slightly, but they've been washed out. They're thoroughly beaten up. There's no sellers left. I mean, how are you going to sell? To get a lower price, you need more sellers, and there's no sellers left for all practical purposes. So I think you would have a very brief downtick in gold, silver, and perhaps some of the mining shares that would be, from a longer-term perspective, totally insignificant. And then you would start to see all three of those classes come up: gold, silver, the physical, and all the derivatives that are associated with the physical metal, and the mining shares as well. Remember, gold's the most negatively correlated asset to the stock market. So if the stock market's unraveling rapidly, and what asset is the most encumbered to go the opposite direction, being gold, then obviously you would see gold gain some strength. So it's one of those things that I think you just have to prepare mentally. I love one of my favorite quotes is chance favors the prepared mind. So prepare your mind for the fact that if there's a stock market crash, unraveling, sell-off, whatever you want to call it, and I believe that there will be in probably the second or third week of January, that gold and silver could be taken down for a very short time. But prepare your mind for that. Look at it as an excellent opportunity if you want to trade, or even if you don't want to trade, and then know that this would be something that is very temporary and it's going to go the opposite way. So I'm very strong on that view, by the way.
Another interesting dynamic here, which we've been covering ourselves, and I know you're following this as well, but gold production, despite a big decline in the underlying price of the metal, has not really fallen yet. And at roughly $1,200 an ounce gold, we're barely above the average cost to mine it now. So how do you see this resolving itself? Will mining costs somehow fall, or will production fall? What do you think?
Well, the free market, what's left of it, will take care of it. I mean, I know mining fairly well, Mike, as you know, and so what happens in a price where you're close to production is it forces gold miners in particular to high grade. So what they'll do to stay in business is they'll go after the highest grade they possibly can if they have that choice. Some mines do, some mines don't. And they will cut back staff. They won't do any overtime. They'll just go on kind of a care and maintenance. That's the wrong choice of words, because that's really when you basically put a mine down. But they go on a schedule that's a maintenance type and above schedule to produce and stay in business. That's what happens. So they try, if they can, and some mines can, will be able to high grade and make a profit or break even at these levels. Other mines won't have that luxury, so they will continue, because it's cheaper to continue a mine at a loss for several months than it is to shut it down right off the bat. That doesn't make sense, and I didn't know that, but now I've been in the industry for so darn long, I learned that the hard way, because being an investor, and still am an investor, I thought, well, you're making a bad decision here. You're costing me money. You're mining at a loss, and that was explained to me. And this has been by more than one company. It's been many times, presented, that it's actually cheaper at a small loss, because once you start to close a mine down, it's very difficult to get it back up. And the contract, there's a lot of labor contracts in that thing, that if you lay people off, you got to give them 3 months pay, or you got to do this or that, or you got to continue their health care, or this or that. So there's a lot to it. It's a lot more than, it's under the cost of production, therefore all these mines that can't produce at that level are going to shut down. Much more complicated than that. What will happen is either the market will take care of it. You have less mining, or you have a higher price, or a combination of both, and most likely a combination of both. You're going to see, a couple of years out, higher prices in the metals, and you're going to see some mines that could have, might have, should have made it if gold prices were, 30% higher than they are now, that fall off to the wayside.
In closing here, and we touched on this a little bit earlier, but what do you expect for metals next year? We've certainly had a rough ride in 2013. What are you looking for in the new year for gold and silver?
I'm looking for an up year. I think the worst is behind us. I think the silver bottom is in. I think it happened the end of June 2013. Certainly it hasn't come way up off of that bottom. That's the way bases are formed. Actually, the longer the base, the more you get coming off the base, believe it or not. That's technical work, and it's been proven in all markets. So I think we're going to see gold and silver prices work their way higher through the first of the year and beyond. I think that you're also going to see the mining equities start to, pick up and show some life. I also think that there's some possibility of a debt market or a financial problem, not necessarily the bond market, but more than likely in that area, but it could be anywhere, that causes perhaps a run to the physical metals. I don't know that. No one does, but certainly there's enough problem areas, you could say, in the financial system that you would certainly, take heed of that statement. So I'm looking for a better year. I think we're going to work our way back up to where we started in 2013. If you look at a chart in January of 2013, silver was about 32 and gold was about 1,700. I think it's going to take probably most of the year to get ourselves back up to that level. But again, it could get through that level within a matter of months, depending on market conditions and what's happening. I mean, this thing with Japan is not good debt-wise. What they're doing, what they're managing their debt, they're not, and the concern between the Anglo-American Empire, which is waning, and the BRICS axis, which is growing, is waxing. They're getting more powerful. China's taking a great deal of physical gold. Russia's keeping their gold, getting more. So you're having one set of powers in the financial system, in the monetary system, that are pro-gold and taking a lot of physical, versus the other side that's held the power for a very, very long time, that's willing to give it up to continue in their power. And, the old adage, he who owns the gold makes the rules. It's going to be interesting how this thing shakes out. I'm betting on the gold side.
Yeah, and it certainly does figure to be very interesting to watch it play out. 2014 could be a big year, like you suggested, but we'll have to wait and see, of course. Well, finally, David, before we let you go, I certainly want to wish you a Merry Christmas and a Happy New Year. And before you leave us, please tell our listeners how they can find out more about the Morgan Report and your great service there.
Well, thank you very much, Mike. I think the easiest thing, there's several ways, but I'll go with the top three. The easiest is probably get on our YouTube channel. And our YouTube channel is Silver Guru, SILVERGURU. If you get on that channel, just about all the interviews I do like this one will be posted on there. Another way to follow my thinking better is to look at our Twitter feed, which is at SilverGuru22. That is sent out by myself personally and my staff. So we, as we read things through the day that we think are really required reading, we throw those out on our Twitter feed. And then lastly, and probably most importantly, you can go to our website, themorganreport.com, and sign up for our free e-letter that comes out weekly. It's called the Economic Update Letter, and we go through usually a question sent in by a reader or some activity that's taken place either in the gold and silver markets or in the economic field, generally speaking, and address that. We also link to some of the interviews that we do during the week. So those are all for free. As far as the main body letter, that's all addressed on the front page of the website, and details are over on the right-hand side on the drop-down window.
Well, excellent insights as usual, and we always appreciate your time. Again, the website is silver-investor.com. Everybody should go and check that out. And David, we look forward to catching up with you in 2014. Well, that will wrap it up for this week. Don't forget to tune in next Friday for our last weekly Market Wrap podcast of 2013. Until then, this has been Mike Gleason with Independent Living Bullion. Thanks for listening, and a Merry Christmas to everybody.
Silver123.net is a silver saver program designed to be as simple as possible. For as little as $50 per month, you can set up and create an automatic cost average buying program that will get silver or gold sent to your door on a monthly basis. The first step to creating an account is easy. You will supply some basic information. Next, you will add a bank account from which you will schedule your purchases. Scheduling purchases makes saving easy. Silver Saver is customizable and allows you to control the amount and the date of purchase. Once you are signed up, you are then given your affiliate code. Now you can save in precious metals and also market this program. You can use email, web pages, and multiple forms of social media to share the Silver Saver program. Silver Saver will reward you generously with physical silver or gold whenever someone you refer becomes a saver. Silver Saver not only provides you with a share code, but also allows you to place your own banner ad on a website of your own. Silver Saver is one of the best ways to start saving and accumulating gold or silver, especially at these levels. Visit silver123.net and start saving today.